Well, hello again, everyone, and welcome to our latest video report. As always, Dion Zukiwsky, branch manager and portfolio manager here with you. And today, we're going to take some shots at some important topics. We know the Stanley Cup playoffs have recently started. Let's go Oilers. And we'll use that as a theme for our video today. We're going to look at the investing season so far in 2022. We're going to look at the types of players in your portfolio and game plans or strategy going forward. Also, we have the Zoo Group's Bond Jewell back here with us today in his Did You Know segment that's going to focus on the impacts of inflation and wealth planning. So in looking at the season so far in 2022, we know it's been a grind for investors. Following a strong year last year, it's been a tough opponent mix so far of rapidly rising interest rates, COVID lockdowns in major economies such as China, and the ongoing invasion of Ukraine, and has all contributed to putting even the most balanced portfolios into the penalty box. Although not pretty, here's what the scoreboard looks like for 2022 so far, looking at the world's major markets. In checking out the graph here, we're looking at year-to-date performance to the end of April across some of the world's largest stock markets. We can see that most developed markets are actually in the red to the tune of about minus 13 to minus 15% so far. The S&P 500, which is the world's largest market, being the United States, is down in double digits. Our Canadian TSX has held up better, but that's because it was propped up because of oil prices. It's now dipped into the red as well. So when it comes to our investment models, there are four main players. First is cash and cash equivalents, then fixed income or bonds, which are primarily for defense, as well as equities, which are shares of blue chip companies designed for growth, and finally, alternatives, which is kind of a catch-all category that includes things like real estate and private equity. Last year, investors scored a hat trick with gains in bonds, equities, and alternatives. As we know, this year's been different. The normally defensive bonds are down, and that's because interest rates have come up so quickly that it's knocked the market prices of bonds temporarily lower. They will come back though. Equities, or share prices, we know the story in stock markets, we just looked at it. Even the most blue chip shares have been put on the bench for now. But the one area that continues to perform has been our alternatives. These pension fund style holdings have had positive performance for the year so far, since they are relatively unrelated to the stock market, and we expect that to continue on. So this brings us to game plan. In other words, what should we do from here? Well, step one is understanding the big picture. We were recently on a conference call with Scotia's Global Portfolio Advisory Group to go through different economic scenarios and how we can move forward from here. The team put together some different economic scenarios in this graphic that we're going to check out. And really at the end of the day, folks, global growth outcomes will be influenced by inflation, which directly impacts how central banks are going to raise interest rates, and of course, the geopolitical uncertainty primarily in Europe. Now, we believe that the most likely scenario is road number one, which is moderating growth. So growth estimates for some companies and sectors will be decreasing, some will actually be moving a little bit higher. Our thoughts are that central banks won't have to tighten rates as aggressively as previously planned. In other words, we think interest rates are going to come up, but not as high as everybody thinks. And that's because Scotia's take at this time is we don't think there's going to be a recession this year. If that plays out, then we should see things normalize, and in other words, markets start to return to positive performance. The other option is perhaps a short downturn, which means growth comes down, central banks are cranking up interest rates, and this sends us into a temporary recession, which would of course be negative for most asset classes and investments. Behind door number three is a protracted slowdown, and what that means is a longer dated recession. Interest rates have come up so fast, it would tip the economy into a recession, and that would cause negative returns going forward for many investments. We don't think that's going to happen. Our most educated prediction at this time is path number one, which is moderating growth. So now with all this information as a backdrop, we will continue to have diversification with those different asset classes or players that help provide risk-adjusted returns. For now, we will maintain a lower than average amount of equity and have a little bit more cash on hand, but when the investment climate becomes more clear, that's going to go right back to work. We have been making more defensive adjustments over the past few months for sure. For bonds, we know returns have not been great this year, but one positive is that as interest rates continue to climb, any new money we put into that asset class will give us higher yields. Even though as investors, we never like to see our market values decrease, it does happen as normal parts of the cycle, which will bring growth in the future again. Keep in mind that world economies, including Canada's, are still expected to post growth this year. And large companies that we look at for investing in are still having positive earnings trends. But we know it's going to be choppy out there, so we're going to stay defensive for now. That's the name of the game. But we do remain cautiously optimistic and ready for when this market correction breaks out of the slump. Along with the conflict in Ukraine, obviously, the biggest things to watch are inflation and how quickly interest rates move higher. Rising interest rates, as we just mentioned, are both positive and negative for portfolios, all in the central bank's efforts to keep inflation under control. When it comes to wealth planning, inflation can be a very important piece to the puzzle over the long term. And with that, I'm going to turn it over to my right-hand man, Mr. Bond Jewell, who's going to explain more in the latest Did You Know segment.
Thank you, and welcome back to our Did You Know segment. Today's segment is on wealth planning and inflation. A thorough plan should always focus on long-term needs. Retirement can last many years, some cases 20, some cases 30 or more. Future income needs should always be adjusted to account for the increased cost that affect purchasing power over time. When I was a kid, they had 1-cent candies. Pennies here in Canada were removed from circulation 10 years ago because the cost to make them was more than what they were worth. In 1995, the average cost per gasoline in Calgary was 50 cents. There's no shortage of examples where we see an increase of costs. Here's a graph that shows the annual rate of inflation for the last 15 years, with the green line as the annualized to-date rate at 1.88% as of 2021. Through the Bank of Canada Monetary Policy Framework is the inflation control target of 2%, with a range of 1 to 3%, with a goal of maintaining price stability. We use this data to apply an inflation factor to your income needs when developing a wealth plan. This increases your income each year to adjust for the increased cost of goods we have to purchase. Our wealth plans are not meant to be a one-time document and should be updated at least every 3 years or unless something significant changes in your life. Please contact us today to get started on your wealth plan or to update your existing plan. That's everything. Thanks for watching.